Money is often imagined as something that already exists and is simply passed from one person to another. Many people think banks are places that store money which savers deposit and borrowers later take out. This picture feels natural because it matches everyday experience. However, the modern financial system works in a very different way. In reality, commercial banks play an active role in creating money itself. This process is legal central to modern economies and widely misunderstood. To understand how banks create money, it is necessary to move step by step through the structure of the financial system, the role of trust accounting practices, and the interaction between banks and central authorities. At the most basic level, money is a social agreement. It has value because people believe it has value and accept it in exchange for goods and services. In earlier times, money took the form of metal coins whose value was linked to the material they were made from. Gold and silver coins had worth because the metal itself was scarce and useful. Over time, carrying large amounts of metal became impractical. Paper notes were introduced as claims on metal stored elsewhere. Eventually, most countries abandoned the direct link between paper money and precious metals. Modern money today is fiat money, which means its value comes from law, trust, and economic stability rather than physical backing. In modern economies, most money does not exist as cash. The majority exists as numbers recorded in bank accounts. When people receive wages, pay bills, or buy goods, these actions usually involve electronic transfers rather than physical notes. This fact is important because it reveals where money actually lives in the system. It lives primarily on the balance sheets of banks. This is where money creation occurs. A commercial bank is a financial institution that accepts deposits and makes loans. Its balance sheet has two sides. On one side are assets such as loans it has made and reserves held at the central bank. On the other side are liabilities such as customer deposits. From the customer's perspective, a deposit is money they own. From the bank's perspective, that same deposit is a liability because the bank owes it to the customer. When a bank makes a loan, it does not usually take existing money from another customer's account and give it to the borrower. Instead, it creates a new deposit in the borrower's account. This is the key mechanism of money creation. The bank records a loan asset on its balance sheet and simultaneously records a deposit liability of the same amount. The borrower now has new money to spend even though no other deposit was reduced. For example, imagine a bank approves a loan for a small business. The loan amount is credited to the business account. The business can now pay suppliers' wages or rent. Those payments may go to accounts at the same bank or different banks. In either case, the money did not previously exist in that form. It was created by the act of lending. This does not mean banks can create unlimited money without limits. There are constraints, but they are different from what many people assume. The main constraints are profitability, risk regulation, and liquidity rather than the amount of existing deposits. Profitability matters because banks are businesses. They create money by lending only when they expect the loan to be repaid with interest. If a bank makes too many bad loans, it will face losses that reduce its capital. Capital acts as a buffer against losses, and regulators require banks to hold a certain level of capital relative to their assets. If capital falls too low, the bank must reduce lending or raise new capital. Risk also plays a major role. Banks assess borrowers' creditworthiness, income stability, collateral, and economic conditions. During periods of optimism, banks are more willing to lend. During recessions, they become cautious. This causes money creation to rise and fall with the economic cycle. Liquidity is another important constraint. When borrowers spend their loan money, recipients may transfer funds to other banks. Banks must settle these transfers using reserves, which are balances held at the central bank. If a bank does not have enough reserves, it must borrow them from other banks or from the central bank. Central banks usually ensure the system has enough reserves to function smoothly, but individual banks must manage their liquidity carefully. Regulation shapes bank behavior strongly. Capital requirements, liquidity rules, stress tests, and supervision limit excessive risk-taking. These rules do not directly limit money creation in a mechanical way, but they influence how much lending banks choose to do. A common misunderstanding involves the idea of a reserve requirement. Many textbooks describe a simple money multiplier where banks lend out a fixed fraction of deposits and keep the rest as reserves. In this story, banks are passive intermediaries constrained by reserves. While this model can be useful for teaching basic concepts, it does not accurately describe modern banking systems in most developed countries. In practice, banks do not wait for deposits before making loans. They make loans first and obtain reserves later if needed. Central banks supply reserves elastically to maintain their target interest rate. If they did not do so, payment systems would fail and interest rates would become unstable. Therefore, reserves accommodate lending rather than limit it directly. This does not mean reserves are irrelevant. They matter for settlement and stability. But they are not the primary driver of money creation. Lending decisions drive money creation and reserves adjust afterward. To see how this works in the wider system, consider what happens when loan-created money moves between banks. Suppose a borrower at Bank A pays a supplier who banks at Bank B. Bank A must transfer reserves to Bank B to settle the payment. If Bank A lacks sufficient reserves, it can borrow them overnight from Bank B or another bank. If the system as a whole lacks reserves, the central bank provides them through open market operations or other facilities. Central banks play a crucial role in shaping the environment in which banks create money. They do not directly control the quantity of money in circulation, but they influence the price of money, which is the interest rate. By setting a policy rate, central banks affect borrowing costs across the economy. Lower rates make borrowing cheaper and encourage lending. Higher rates make borrowing more expensive and discourage lending. Central banks also act as lenders of last resort. In times of stress, they provide liquidity to prevent bank failures from spreading. This support reinforces confidence in the banking system, which is essential because banking is built on trust. Depositors believe they can access their money when needed, even though banks lend most of it out. Trust is the foundation of money creation. When a bank credits an account with newly created money, the value of that money depends on the belief that others will accept it in payment. This belief is supported by the legal system, deposit insurance regulation, and the central bank backing the system. Deposit insurance is particularly important. It assures depositors that their money is safe up to a certain limit even if a bank fails. This reduces the risk of bank runs where many customers attempt to withdraw funds simultaneously. Without deposit insurance and central bank support, the money creation process would be far more fragile. The interaction between banks and the real economy is complex. When banks expand lending, money creation increases, which can stimulate economic activity. Businesses invest, hire workers, and produce more goods. Households buy homes, cars, and services. This can lead to growth, rising incomes, and higher employment. However, excessive money creation can also contribute to problems. If lending grows faster than the productive capacity of the economy, it can fuel asset price bubbles. Real estate stocks or other assets may rise in price as more money chases limited opportunities. When these bubbles burst, banks suffer losses, borrowers default, and lending contracts sharply. This can lead to recessions or financial crises. History provides many examples of these dynamics. Periods of rapid credit growth often precede financial instability. The global financial crisis of the late 2000s was driven in part by excessive mortgage lending and complex financial products. When housing prices fell, loan losses spread through the system and money creation reversed. Banks reduced lending, deposits shrank, and economic activity declined. During crises, central banks often take extraordinary measures to support money creation indirectly. They lower interest rates, sometimes to very low levels. They provide long-term funding to banks. They may also engage in asset purchases known as quantitative easing. Through these actions, central banks aim to stabilize financial conditions and encourage banks to continue lending. Quantitative easing involves central banks buying government bonds or other assets from the market. When they do so, they create reserves and deposit money in the accounts of sellers. This increases the monetary base but does not automatically lead to increased bank lending. Banks may hold excess reserves if profitable lending opportunities are limited or if they are repairing their balance sheets. This highlights an important point. Money creation by banks is demand-driven as well as supply-driven. Banks can only create money if borrowers want to borrow and are deemed creditworthy. In times of economic uncertainty, households and businesses may reduce borrowing even if interest rates are low. In such cases, money creation slows regardless of central bank efforts. Another aspect often overlooked is the repayment of loans. When a borrower repays a loan, the money created by that loan is destroyed. The bank reduces the loan asset and the deposit liability. Interest payments, however, remain as bank income and do not disappear. This means that over time there is a continuous process of money creation and destruction tied to lending and repayment. This dynamic nature of money challenges the idea that there is a fixed stock of money circulating in the economy. Instead, money is constantly being created and extinguished. The size of the money supply reflects the balance between new lending and loan repayment. Understanding this process helps explain why economic growth is closely linked to credit growth. Expanding economies tend to see expanding balance sheets. Stagnant economies often experience weak credit growth. But this also explains why excessive reliance on credit can lead to instability. Different types of banks play different roles in money creation. Commercial banks that take deposits and make loans are the primary creators of money. Investment banks, money market funds, and other financial institutions operate differently. They may create credit-like instruments, but these are not always counted as money in the same way. The distinction became important during financial crises when shadow banking activities created risks outside traditional regulation. Governments also interact with money creation in important ways. When governments run deficits, they issue bonds. Banks and other investors may buy these bonds. When banks buy government bonds, they may create deposits in the process. Government spending financed through the banking system can therefore contribute to money creation. Taxes work in the opposite direction. When taxes are paid, money is transferred from private accounts to government accounts at the central bank. This reduces deposits in the private sector. However, government spending typically returns money to the economy, so over time the effect depends on fiscal policy choices. Some theories emphasize the role of the state in defining money. According to these views, money derives its value from the fact that the state accepts it for tax payments. This perspective highlights the legal and institutional foundations of money creation and complements the banking-centered view. Public understanding of money creation remains limited. Many people believe banks lend out savings or that central banks print money and hand it to banks. These simplified narratives can lead to confusion about policy debates, inflation, and financial stability. A clearer understanding allows for more informed discussion. Inflation is often associated with money creation, but the relationship is not mechanical. Inflation occurs when aggregate demand persistently exceeds aggregate supply. Money creation can contribute to this if it fuels excessive spending. But money creation that supports productive investment can increase supply and reduce inflationary pressure. The context matters. Recent debates about digital currencies and central bank digital money have renewed interest in how money is created. A central bank digital currency would allow households to hold accounts directly at the central bank. This could change the role of commercial banks and the structure of money creation. The implications are still being studied and debated. What remains clear is that the current system relies heavily on banks creating money through lending. This system has supported economic growth for decades, but it also requires careful regulation and oversight. Trust, stability, and prudent risk management are essential. Education about money creation is important not just for economists but for citizens. Decisions about regulation, interest rates, housing credit, and public spending all relate to how money enters the economy. Misunderstandings can lead to misplaced fears or unrealistic expectations. In conclusion, banks create money not by printing notes but by extending credit. This process is rooted in accounting, trust, and institutional support. It is constrained by risk, regulation, and economic conditions rather than by existing deposits. Central banks influence the environment but do not directly control the quantity of money. Money creation is dynamic, reversible, and closely tied to the real economy. Recognizing these realities provides a deeper understanding of modern finance and the forces that shape economic life.